Happy Tuesday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Tuesday, March 18th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is the rotation into European assets durable? Our answers are this week, Germany's on the cusp of expansionary fiscal policy that could reshape its economy and reverberate across the broader Eurozone. European stocks are rallying and the euro is strengthening in anticipation of the German parliament's approval of a massive spending program. The landmark vote expected to greenlight a euro $500 billion investment package represents a departure from Germany's traditionally conservative fiscal stance. The outcome will likely boost economic growth across Europe, durably impacting market performance and investor sentiment. Breaking down the spending package, Germany's proposed fiscal expansion has three primary components: a euro 500 billion off-budget fund for infrastructure investment, an exemption allowing defense spending above 1% of GDP from fiscal constraints, and increased borrowing allowances for Germany's 16 states, capped at 0.35% of their respective GDPs. These measures are projected to inject an average of 42 billion euro per year into the economy, equating to nearly 1% of Germany's GDP. Additionally, states are expected to invest another 15 billion annually, further bolstering growth. As Germany embarks on this ambitious fiscal experiment, the ramifications for global macro markets will be profound. Durable risks to U.S. exceptionalism continue to mount, especially if other European nations and the EU itself follow through and approve large defense spending proposals. With the presently dour U.S. policy mix featuring contractionary fiscal policy and out-to-lunch monetary policy set to deteriorate in the coming months, we believe the risk of a sustained outflow of capital from U.S. assets is greater than consensus realizes. Transitioning to our 42 macro dashboard, as always, a wrap up the question from our community. This one's regarding the dollar. It says, hi, Skipper. Hope you are well. Thank you. Hope you are well as well, my friend. Says, please can I ask you to elaborate on the potential for dollar strength or the lack thereof in the context of a refinancing air pocket, especially given that the net international investment position in the U.S. is deeply negative? Your insight is always appreciated. So this, in my opinion, is one of the most important questions. Really proud of our very thoughtful client base. I can't imagine there's too many client bases around the world that are more thoughtful than ours, just given the mix of clients that we have across global Wall Street and across global Main Street. We have a lot of really, really smart retail investors as well that ask phenomenal questions like this. In my opinion, one of the, as you guys know, we've been talking about this for months now, for quarters now, the number one risk to asset markets in 2025 is a global refinancing air pocket. The kitchen sinking of the economy by the Trump administration is potentially contributing to that by causing an exodus of capital from U.S. assets. Right now, that exodus of capital is supporting the expansion or the appreciation of global assets and the decline of U.S. assets. At some point, it might turn it from capital rotation to capital destruction, and that is an extremely high risk over the medium term if U.S. growth slows much faster than consensus expects, which we think is a reasonable probability of occurring, and you don't get the kind of liquidity provision from the Fed on a proactive basis that we believe is necessary here in 2025 to prevent that global refinancing air pocket. So, in our opinion, we definitely believe that this is the question to ask. What is the dollar signaling? Right? Go back a couple of weeks ago, the dollar had a 3.5 standard deviation week over week decline. Historically, that's been sort of correlated, or historically, whenever you've seen these massive declines in the dollar on a short-term basis, is typically kind of in and around the low in the liquidity cycle. But in our opinion, we believe this may kind of be a red herring, if you will. And part of the reason it may be a red herring is just the overcrowding of positioning that we observed at the February 19th high when our positioning model signaled there was a high risk of a crash. That overcrowding positioning into the U.S. exceptionalism theme is a market risk, especially in the context of all the historic acceleration and global debt refinancing demand that's likely to take place. So I think kind of tying a bow around all of this, because it's very complicated stuff, there's likely, if U.S. growth slows faster than consensus expects, which again think is a reasonable probability of occurring, you're probably going to see more down dollar. Historically, down dollar is positive for global liquidity. However, it may not be in the context of what is more than likely to be a decline in global trade as a function of President Trump's trade war, and what may actually be a decline or a slowdown in global growth that's kind of being catalyzed by a drag U.S. economy that's dragging global growth lower. So I think, if the dollar has a persistent downtrend, eventually that will be positive for liquidity. You're going to eventually see liquidity start to rebound as a function of that. But there might be an air pocket between dollar down and liquidity up. And that air pocket between dollar down and liquidity up could be a significant amount of market risk, just given the starting point of where we were at the all-time highs in February, at least according to our positioning cycle. So hopefully that is helpful. Obviously, there's a lot of institutional grade analysis that's supporting all those different conclusions featured in our macro scouting report presentation, which I'm staring at all 161 slides of on my big monitor here. Hopefully, but hopefully I explained that. I summarized the analysis reasonably well enough in the context of what is a very rapidly evolving global macro landscape. So we'll wrap it up there. Darius Dale here presenting our macro minute for Tuesday, March 18th, 2025. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.